Happy Friday and welcome back to Real Estate Mindset. Good morning to all of you. I was able to make it Friday. Don't forget, you guys, I will be back on Tuesday for another morning live. Really excited about this live. I'm going to do things a little bit differently today. I had a special request to go over some information, but I'm going to first go into obviously a quick mortgage rate update, but also, guys, the request I got was to break down and respond to a video from the Educated Homebuyer podcast. Now, normally I don't really want to do that. I don't want to waste my energy, analyzing people and reacting to people. I would prefer to stay in subdivision analysis and really educate you guys, but I've had a request to respond to them, so I'm going to do that again apprehensively. So I hope you guys enjoy. As always, everything will be linked in my description, and I'm going to start right now, guys, by let's just go into a quick mortgage interest rate update. So right now, here's the 10-year. 10-year obviously has been skyrocketing. We have runaway inflation. A lot of people, including Jack, you guys may have seen the video yesterday, are thinking this is going to hit 5%. I hope it hits 5%. And the reason is, to be very specific here, I want buying demand to stop during spring and summer buying season right now so that we can have balance or make progress in the balance that we need in the housing market. So in other words, we need more sustained inventory. We need inventory to catch up and we need demand low. And that's why I'm saying that, guys. But right now we're sitting at 4.658% on the 10-year, down about 5 basis points this morning. Very interesting. So keep your eyes on that. Obviously, when interest rates update today, they're probably going to be much lower. So let me show you where mortgage rates are at right now. So anyways, today's mortgage rates, this is as of yesterday. Again, this update's around lunchtime. But right now, guys, we're sitting at 7.52% on conventional 30-year fixed, okay? On FHA, take a look again. Remember, FHA has lower interest rates, okay? But they have higher fees, generally higher fees. But 30-year fixed is 52 basis points lower, sitting at 7%. That is also under VA. Very interesting to see now the gap in the 15-year. The 15-year is now lower than FHA. Very, very interesting to see that. But either way, you guys, thank God we have elevated interest rates. I've been wanting this for the last year. Thank God we have it because, again, inventory should start going up and sustain. Let me show you guys what the market is actually thinking as far as what's going to happen next with interest rates. This is so crazy. If you guys have been sticking with me on my live videos, you've seen this change drastically. You've seen the market continuously be over-optimistic, continuously get projections wrong on what's going to happen next with what the Fed's going to do. But anyways, guys, I'm going all the way to December of this year. So when I go all the way to December of this year, that's really all I care about at this point. Honestly, I don't even care about this that much. But take a look, guys. The market is certainly shifting to the fact that there will be no rate cuts. And really, the only reason we would need rate cuts is to stimulate the economy. If something breaks, if something doesn't break, we're not going to have rate cuts because if they cut rates when they're fighting inflation, it will just add to the inflation. It will stimulate money and money printing and consumer spending and prices going up and things like that. And so this is important, right? It's important to have high interest rates right now. High. I said high interest rate. It's not even high interest rates, but not 0 and 1%, obviously, but 17.6% now priced in that we will not have rate cuts in 2024. 17.6%. Very, very astonishing. So anyways, guys, that's your mortgage update. So now what I want to do is I want to move on to the Educated Homebuyer podcast. And again, I'm doing this because I have a request and I got an email, and I'm going to go on the record. I'm going to say this one more time. I prefer, especially on my lives, guys, I prefer to stick to like how to empower consumers, right? Subdivision analysis, looking at comparable data, making adjustments, looking at homeowners insurance, looking at credit, looking at appraisals. But I got this email. Let me show you guys the email that I got real quick. So I got this email, okay? And this is why I have to react in this video. So I got an email from Scott Keltner. If you're online, Scott, comment in the comments below. If you're online, understand this is one of the reasons why I'm doing this. But even after I read this email, guys, I still didn't want to do this. But take a listen to this email. This is from Scott Travis. If you got any time, I hope you might consider watching this video. And this video is of these guys. I mean, it's your normal realtors talking about real estate, right? But he goes on. Okay, and here's the link to this video right here. These guys cover about, I'm not sure what that means. These guys cover about all my fear points on the housing market. I watched this video and left completely deflated. And I'm already thinking, like, if this is an educating home buyer podcast, then why are people feeling deflated? So this goes on. It seems like the home affordability pain is just never going to go away. It would warm my heart to hear your response to this video. And I know you're a data guy, and you could probably counter their arguments pretty well. Okay, so I got that email, and still, you guys, I love my people, I love my community, but I still didn't want to do it. But just for kicks and giggles, because again, I've been listening to realtors for 20 years, you guys. Now, I still watched it though. Okay, so I watched this video. Now, before I dig into this, I want you guys to understand that the people that are talking right now, their housing market is California. Okay. And so I can kind of understand why they're leaning the way they are, because California is different from my market here in Texas. And I also understand, so I understand that. And I also understand, and I'm just acknowledging this, I do have a deep-seated hate for most realtors. Okay. I get frustrated, but you guys, if you're like me and you watch for 20 years, realtors take advantage and wreck consumers, would you not? I mean, wouldn't you feel the same as me? So I know that that's there, but anyways, guys, so I go there and I'm looking at the comments, and I'm seeing these comments, and I see this first one from Comic Lover, and I'm like, oh my God, Comic Lover's on here. Like, geez Louise, and I wonder where he gets this information from. But you guys, Comic Lover's like, blah, blah, blah. I'm disturbed. Travis isn't using data. I'm thinking he's talking about the Fred data that says all U.S. homes median sales price. I'm looking into that, guys. But anyways, he's going on. And just real quick about Comic Lover, man, so he's saying, oh, I banned him from commenting on the videos. You guys, the problem is I have a huge heart. I'm naive for people. I let people in, and my mistake was I let Comic Lover in. I know where he lives. He asked for all my help on his house. I gave him help for free. And then he turned around and was talking smack. He turned into a cancer. Not only a cancer for my well-being, but a cancer for the community, because the guy was only concerned about being right, and he was wrong all the time. And so honestly, and I can say, I talk about cancer because I'm getting my test done for Lynch syndrome. You guys should know that precancer. It's a highly metastasizing genetic disorder that I talk about, that I have sometimes. So I fuck off a right, and that guy's cancer. And so, it was my mistake for letting him in, and that's why it hurt. But anyways, here's what got me, guys. Okay, so then the educated, and still, I'm reading this, I'm like, I'm not going to do it. They're entitled to their opinion. I don't want to give them the smoke. But then they responded to Comic Lover. They responded and said, not surprising. They're talking about me. They're saying, not surprising when the data isn't on your side. It's tempting to distort the facts. A little work with Google machine makes almost anything fact checkable. Not sure why anyone would risk their reputation. So when I read that, you guys, I'll be honest here. I was like, all right, fine, guys, it's fair game. And again, this reaction is going to hurt me because the other guy's a loan officer, and I have a huge respect for loan officers. And Todd, I know you're watching. I don't want to argue with you, Todd, about this. It depends on the person. But I don't like attacking loan officers because I know all the crap that they have to deal with. But I get Todd's point. I know Todd's in the chat. I get his point. Still didn't want to do it, guys. But I'm going to try to do the best I can to be completely neutral, unbiased. And the first thing that I want to point out, so they're basically saying that I'm just making crap up and I'm not even using the data. But I want to bring, if they're watching, I really want to make a point. Let's go back into what I wanted to show you. Okay, so here's my last live video right here. You see that? Really unattractive picture of me. I'm in my 40s. That happens all the time. I got to only hit the right angles of cameras, certain way to look like I'm young. But anyways, you guys probably notice that when I do my walkabout videos. So, this is my last live. This was from April 23rd, guys. And look at this. Not only do I have chapters, look at all of the data. You guys, I got 23 data links. How are they saying that I'm not using the data? Even data that I don't like, it's all linked right here. You guys, people make mistakes all the time. I get it. I mean, I'm talking about 23 different data sets. Sometimes people make mistakes. I make mistakes. The data's linked here. The thing is, guys, when they're preaching, when they're criticizing me about not using data, at least reference the data that you're using. By all means, criticize me. It's a free country. It helps with competition. It keeps people sharp. But if you're going to criticize about data and you don't link the data yourself, kick rocks, man. I mean, it's just hollow. But look at this, guys. So I go to their video, right? I go to their video to see if there's any data, and all I get here are links to pay them money. You guys, and this is the thing. I didn't want to bash them. They're realtors that made a podcast to get leads. There's no data here, guys. When I click these links, this is what comes up. Here's the first one. Boom, join the community. Okay, fine. Here's the second one right here. Boom, join the home buying community, $5 a month. Okay, charging $5, only 12 members. First of all, why am I even responding to these people? Why do you guys want me to respond to these people? It's just your 2-bit realtors on YouTube. Why are you listening to that? Anyway, so $5 a month there. I go to this next thing. Boom. Look at connect with a realtor and a mortgage professional. They have a mechanism that is designed to lead people to this page right here. This is a referral page. So again, you guys, you have to understand, you know, if you watch this stuff, don't get upset. Don't get annoyed. You can get annoyed, but don't get upset. You have to understand where people are coming from and the intention on why they're doing things. And they are trying to get leads. And so when they speak and when they talk and when they make points, obviously their points are going to lead you to buy a house. Now, I kept going, you guys, and I was like, you know what? Let me see what Jeb's about. So I went to the ratings and reviews on Google, and I'll go into the video here in a minute. But first, I wanted to let you guys know I had 23 data sets, and these guys are clowning on me. Like, seriously, guys, you don't have any data sets. You're going to clown on me and you don't got any data sets? Like, are you guys live in reality? I mean, geez Louise. But anyways, so I went to this report here and I was like, okay, Jeb's got 83 reviews. That's pretty solid. 4.9 stars, pretty solid. And then I went to newest. Okay. Again, I just went to newest. And you guys, I read this first comment. This is from Brittany Jones. This is talking about Jeb. Okay. This is just, I don't even know if this is real, to be honest with you. They're just slamming him, saying he sounds racist, that they're mad about his opinion, but they're not really going in. So again, I don't know if that's real, but I thought what was interesting is Jeb's response to that bad review, which specifically, you guys, let me read the second paragraph. So this is his response to that review. He said, that said, it's important to understand that because I do YouTube videos and not everyone qualifies, that somehow I'm the reason. So people like to come and make remarks that make stupid remarks like somehow it's my fault. So, I mean, Jeb, dude, you're calling people stupid. You know, if here's my opinion on it. Again, I'm not saying this is real. I'm saying that the most recent reviews have both 1-star ratings. It does look fake because it's just someone, being upset. But when you're saying, stupid remarks like that, I mean, that's a reflection on you, Jeb. Why would you call them stupid when you have something fake like this? This is your opportunity to shine as an agent. That's just my opinion, obviously, you guys. But anyways, so I hope so far what we've established is they have absolutely no data that they're using and referencing. And on my videos, I go out of my way to use data. You guys, so anyways, so first of all, the whole thing is not sitting well with me. But anyways, we're going to go into the first part of the video, okay? Let's go into this first part of this video right here. It's going to be brief, and let me know, you guys, if you can. Actually, you know what I'm going to do? I'm going to do it like this. And let me know that the audio is okay. So here's what we're going to listen to. We're going to listen to this first part of this video. This first part of this video is going to be him explaining why prices of houses are sticky, okay? And that they're probably going to go up. But I also want to tell you guys, and I'm not going to waste our time here. Here's the issue with people like them, okay? They're not defining what a crash is. They are not telling us as the viewers what's the definition of a crash. They're throwing around the word crash to use it to get you to fly into whatever narrative they want. They are not defining it. You have to define it. What is it, Jeb? What's a crash to you? Is it 30%, 40, 10, 20? Is it neither of them? What is a crash? If you don't explain it, then it's just like you're hiding that from us. You can use it and flip-flop and do whatever you want. You have to explain it. I have explained my definition, and I've never wavered from that from day one. From day one, I've explained it. This guy's not explaining it. So I want you guys to listen. He gives 3 reasons why home prices are sticky. And then what we're going to do is we're going to analyze all 3 of those reasons. And we're going to see, is this guy just a grifter or do they actually educate home buyers? All right. So if you guys can, let me know that the audio is okay.
And therefore you might see prices come down. But what we're really talking about here isn't prices leveling off, prices coming down. We're talking about the idea of a crash. Why a crash is,
what's a crash?
Is not likely. And in a lot of markets out there, you're not really going to see that pullback in prices either, at least in the near term. And it comes down to supply and demand. But on top of that, let's just talk about the general premise of home prices being sticky to the upside with, the basis here. Necessity, emotional attachment, and the idea of illiquidity. So when
Okay,
we
you guys
talk
got
about
that?
those three things, Josh, what are we at?
Okay. So the three things here, you guys don't worry, I have all the data. I have all the data like I always do. So there's three things that he mentioned. Okay. So there's three reasons. And again, I'm not going to bore you. We're just going to listen to clips of this. But his three reasons for, strong prices is number one, emotion. Okay. So already I'm thinking, like, you guys see what I'm saying? Like, the realtors, it's just, they don't know any better. The only thing they were taught this, okay, to make a fear of missing out to get you to purchase a house. They all say the same things. And again, no data. But the first thing was emotion. The second thing was necessity. So it says, is it a necessity? Okay. The third thing is equity. Okay. So I want to start by going into emotion. All right. And I just wanted to remind you, Jeb, that you were part of the problem. If you were leading people into purchasing houses based on emotion and not data, not subdivision analysis, and remember, you guys, it's about subdivision analysis. If you were leading people based on emotion and saying it's okay, it's emotion, but it's not like the stock market, it's just going to go up, then you, sir, were part of the problem. Okay. You guys remember FUMO helped drive up housing prices in the pandemic. That's not healthy. That's not a good thing. But yeah, it is part of the reason. And I want to read a few things here, guys, just a few snippets. Everything's going to be linked in my description. Now, this starts off, FUMO has been alive and well. It is a deep-seated emotion that may have no logical connection with any extreme forecasts. Most people stay in their purchased home for many years. Their sense of meaning, their love, tend to be all tied up in their home. So they know that. Realtors know that. They play the emotions. I mean, we get that. I'm not saying all realtors, but a lot of them do. Now, no wonder that FUMO may be triggered by the thought at a time of stress that we may have just missed a once-in-a-lifetime opportunity to afford the dream house. You guys, we got locked down. Okay, remember, that's why rates went low. We got locked down. No one saw that coming, so don't beat yourself up if you feel that way. Second paragraph, remember how strong emotion is. One has to reflect on the swirl of emotions that affect us these days and recognize their legitimacy, but not overreact to high prices. Take a long time to search for your dream house, even as mortgage rates are going up. And don't forget that real inflation corrected prices may be substantially lower after this wave of fear of missing out and other factors prompting high home prices during the pandemic weakening with time. Okay, so I get it. So he's not wrong, you guys. I mean, that's a sad part of it. Okay, the sad part of this is the fact that we are in a housing market. I mean, it's a fact. I mean, the housing market and the consumers are very ill prepared. And that is a fact, you guys. They're very unprepared. Most people, they don't want to deal with it. Even my clients right now, they don't want to deal with it. I mean, they're very, very strong people. So the first thing is emotion. And I would say there's validity there as far as the emotion. Now, if it's me and I'm trying to educate home buyers, I'm going to tell people, but check your emotions, because your emotions can get you in trouble, especially if you're using emotions to purchase the biggest transaction of your life and you're using strangers like realtors and you trust them fully. You can trust but verify. If you're not out there verify, the economy, the market, the world, the reality that we live in will blame you instead of the realtor. Even though I'm sitting here saying behind the scenes, it's the realtor. It's more the realtor's fault, okay? Because they understand the emotional aspect of this, okay? But anyways, okay, emotion is one. The second thing is necessity. So they're saying prices are going to stay up because it's a necessity to have a roof over your head, okay? But the thing is, guys, remember, we could still be great people. We could still be good people. We could still start a family renting a house. The key is we don't want to rent a house forever, right? We want to rent a house for as short a time as possible until we find our dream home. But the thing is, guys, again, the way that it's phrased out of necessity gives us the impression that the only way to start a happy family is owning a primary residence, and that's BS. That's BS, you guys. Home is where the heart is. So I understand the necessity, but let's not forget this, guys. Let me show you some data, okay? Let's look at the rent data. Here's the rent data. So when they're saying that, again, they're not acknowledging this right here. This is a big factor on what's going on in America with consumers, guys. This is the chart. Okay, this is a chart basically showing you guys the gap in difference versus renting and owning. There's literally never been a better from a standpoint of affordability, there has never been a better time to rent. If you look at this versus own, there's never been a better time to rent than right now. If you look at that gap right here, this gap is saying there is 62% more expensive to buy a home versus rent. But again, they're saying no, as out of necessity. That's where you start your family. That's where you're going to be happy. But personally, if my payment's 62% lower and I'm able to save money and increase my purchasing power, I'm a happy person. I have a happy life. But I keep going back to the premise that you guys, if these bozos are out there telling you and making you feel bad like you have to buy right now or you're not a good person, that's nonsense. That's nonsense. Now, the third thing was illiquidity. Okay, so let me just break that down for you guys. Okay, so illiquidity, what does it mean? Equity. So now they're saying equity. Okay, and here's the thing, you guys, to be realistic, yes, I mean, normally I would agree with them 100%. I'm not trying to give them the smoke, but the thing is, we have to adapt to what's happening right now. No one exactly knows what's going to happen next, but we have to adapt. So you have to adapt because their point is that eventually real estate goes up, right? That's their point. And that's true. Eventually, usually real estate goes up. And that's why, again, I think it's a great investment. But when we have times like this of massive unaffordability, it's so important that if you do decide to buy, that you're buying with the right expectations, with wedge, with cash flow, no consumer debt, you're not using your emotions. And I don't hear any of that. And again, I don't watch them all the time. I just watched that one video, so maybe they do this, but I didn't hear anything in that video that they were talking about that helped me as a consumer in any way. In fact, it made me feel like basically what they're saying is houses aren't the stock market. It's okay to purchase a house emotionally. They're saying houses aren't the stock market, so it's okay to purchase emotionally. I don't agree with that. Let me show you prices. Here's prices right here, you guys. This is median price for new homes and median sales price for resale homes or existing homes. And the thing is, you guys, you got to be very careful making blanket statements. Like, I can't say the housing market has crashed. I can't say that because I've defined a nationwide decline of 15% from peak, and we didn't hit that. So I can't say it, and I have to acknowledge that. But we did hit it with new homes. You guys look at new homes. That's the red arrow. So they must not be talking about new homes because new homes has been on a tear downward, except recently the data came out, which will probably be revised downward, where it did jump in March of 2024. But regardless, you guys, if you purchased on average, it depends on subdivision, it depends on how you're purchasing, but you're down if you bought a new home. So you got no equity. And the same thing with existing. You guys, existing, okay. I think it was Thursday, we finally hit a 4-week rolling average new record. We didn't hit a month-over-month median new record like Dave Ramsey said we already hit. So we did hit that, but I want to show you this, okay, the green line. Look at this, guys. So it really depends what market you're in and what time you bought, because if you bought at any of these peaks right here, your value went down immediately. This is extreme seasonality with quantitative tightening and unaffordability, low demand, low inventory. That's what you see right here. And you guys, we don't even have price discovery yet. But my point is, here's the thing. Okay, and then we're going to get to the next part of the podcast. Here's the thing that I'm really trying to explain. In my opinion, okay, they did a really, really poor job at explaining the differences of what a homeowner was prior to 2022. They continue to talk on that home buying podcast as if any buyers today are the same buyers as 2020 and 2021. If you purchased in 2020, if you purchased in 2021, on average, you won. On average, you won. You have a low interest rate, other than the property taxes and insurance. Those are horrible, but you won. You probably have low rate. You probably have a whole bunch of equity. But the thing is, guys, they're talking as if buying in 2024 is the same thing. At best, you're getting 4 or 5% equity growth. And it takes 8% to sell your house, maybe 4% to refinance. And so the poor job so far that I've noticed up until this point in the video, again, is they're not making the distinction between the two different categories of buyer, which is 2022 and before and 2022 and on. And that is very, very dangerous not to acknowledge that massive distinction, because what consumers need to know right now is what's going on right now, not what happened in 2020, 2021. Everyone in the world knows that house prices went up, but don't forget, in order to get a house back then, bidding wars, waiving contingencies. Remember that? Shopping house online, going appraisal gap. So don't beat, again, I say, don't beat yourself up. You had to sacrifice all of your fundamentals and morals just to be a player in the housing market, okay? So let's go on to the next part of this video. I hope I'm explaining this, those three things, fairly well. I just think there's just so much missing information. And when you're, acting like you're an educated home buying podcast, you really got to try, and I know it's hard, so I'll give them that. You really got to try hard to really talk with extreme specificity, and it is hard. So again, I'm going to acknowledge it. Now, oh my God. So we're going to go into this next thing, guys. Again, and I'm saying specifically, you don't need to buy a house to be a good person. Okay? You don't need to buy a house to be a smart person, to be a valued member of society and the community. That's not what makes you good. It's your heart, man. I hate this capital. I hate this game so much. I hate this game. So now we're going to go into whether or not homes are overvalued. Okay? You guys, I'm trying to really make it through this like really hard. I'm really sorry. I feel like I'm like really getting caught off guard here by my emotion. Anyways, guys, let's get into this next little bit here. This is going to be about a minute. Again, are homes overvalued or not? And look at the data that they're missing, but let's just play 1 minute of this.
Of illiquidity. So when we talk about those three things, Josh, what are we actually talking about?
The necessity is probably the most important part. We get a lot of these really smart Wall Street analysts and tycoons telling us, hey, housing is fundamentally overvalued. They're looking at it like a stock, and they say, based on my metrics, it should be 30% lower. And they may be correct. But the reality is no one needs to own a stock. They do have a necessity to have a roof over their head. So what are our options?
Okay. So he said maybe they're correct. Maybe they'll go down 30%, but who cares? It's a necessity. Did you guys catch that? Who cares if it goes down 30%? Because it's a necessity. Did y'all catch that? I can't even believe I got an email. I can't believe I got an email from Steve asking me to respond to this absolute garbage. He just said, yeah, maybe they're right. Maybe it will go down 30%, but it's a necessity. I can't believe it. Steve, why do you want me to respond?
Some people have the option of living rent-free. They can move in with family. They can couch surf with their friends. There are a minority of people who can live rent-free. Other people can rent and put a roof over their head, or they can buy a home and put a roof over their head. Once someone has joined that roughly 2/3 majority of American households that want to own their home, they are very reticent to go back to being renters or living rent-free, moving back in with their family. So there is a strong incentive to remain a homeowner, to fill that necessity for having a roof over your head. So it's not a fair comparison to look at it as a stock or a mutual fund or something in your 401k. And
okay, so I mean, I agree. You can't look at it as a stock. I mean, why are they saying that to us? Where's the education here? Was the education that it's not the stock and it's okay to buy? Because that's what I'm getting, you guys. That's, again, the premise there is it's not the stock market. It's okay, just buy. It's okay to buy emotionally. Prices will just go up. And if they don't go up, it's okay because you want to live there. Do you guys hear what they're saying? At least that's how I'm receiving it. That's how I'm receiving it. So here's the thing, okay? They're like, oh, these big type, the data, right? They're like these big Wall Street smart, super blah, 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 blah. They're saying it's overvalued for who cares? Why? They never reference the freaking data. And that's what I hate. So again, you guys, I'm not making money. They're the ones that are funneling hundreds of thousands of dollars in commission, leading people into purchase houses. When you say that, and you don't acknowledge why are the Wall Street bulls saying what they're saying, and you're not using the data, and then you're going to criticize me for not using the data, then you're just a washed up 2-bit realtor that needs to be replaced by AI because you make things worse. You need to be replaced by AI. We could call it the Jeff Smith AI. You guys can get a pretty little picture, talk all perfect to you, whatever, but it's freaking trash. Reference the data even if you don't like it, because you got to caution people. Fine, help people. Todd still helped people. I helped one person, okay? But we're cautioning them as like crazy. I'm telling people to walk away like crazy. I drove to Dallas. I drove 9 hours to Dallas to meet a subscriber who flew in from California to tell them to rent and not buy a new home online. Took 9 hours of my day, drive time only, to do that. That's how I'm educating home buyers. How are you, Jeb? How are you? Because it looks like all you're doing is saying you're educating people so that they trust you, so that they submit a lead. Am I wrong? But let me show you the data, okay? This is why This is why people are saying overpriced, starting with national payment to income ratio. Keep in mind, this is not counting property taxes. This is not counting homeowners insurance. This is only counting principal and interest. That's not how loan officers calculate affordability. The biggest fluctuating expenses for houses right now are property taxes and homeowners insurance, and that's not calculated there. So in my opinion, this is not a fair comparison, but we're sitting at 34.4%. Usually we're way down here. We have a higher national payment to income ratio than the GFC. We have as high an affordability, talking about payment. I'm not talking about price. I'm only talking about payment now, than the 1980s. It's more expensive. We're not talking about price. We're just talking about payment for a second. You guys, it's more like 44%. And also, this is using a 6.875. Remember, interest rates are what right now? 7.5%. You sure you want to go buy a house right now and get a 7.5%? If you do, you better make sure you're insulated, and you better make sure you know what that means. And trust me, guys, I'm in a loose market. I'm looking every single day. Those deals are hard to find, almost impossible to find, but they can be found. We know that for sure. But anyways, there's one set of data right there, buddy. Okay, I'm going to link that in the description, Jeb. Okay, that's going to be linked in my description. I would suggest you do the same. Now, this is the other one. Now, here's prices. Prices went up too high. I don't think it's sustainable. I explained why. I'm going to show you guys why I'm using the data. Why are people saying I'm not using the data? I'm not only using the data, I'm showing you the data. I'm linking the data. Why are these people saying that? They're saying that because I'm messing with their money flow. And it's just easy to have some, dim-witted response. Because as long as I'm not messing with their money flow, they don't care. They probably have never even watched me. They just want the money flow to continue. Here's the home price to median household income ratio. All right. Now, depending on the data source, it will show different things. I'm using long-term trends right here, you guys. Again, this is how many years of salary does it take to get your home paid off? And I just want to go back to the great financial crisis. During the housing market bubble, we reached 6.81. Okay, right now, and this is still as of December, this is not updated yet, we're at 7.61. Again, Jeb, educated home buyers, please just acknowledge the data. Just acknowledge the data, link the data, okay? That would be helpful, just like I'm doing, and I have been doing since day one, okay? But that's one reason why the Wall Street bulls are saying what they're saying. All right, take a look at this. Here's another one. Oh my God, I love this one. Jeff M better be online. Jeff, are you online right now, Jeff? I want to tell you something, Jeff M. Where's Jeff M at? Oh, Jeff M, comment. I want to make sure you're going to hear this next part, Jeff. This one's for you, special for you, Jeff. Oh, there's Jeff. All right, Jeff, pay attention. I want to talk about this, okay? A lot of people are comparing what's going on now to the 40s, the 70s, the 20s, the 30s, the this, the that, the blah, 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 blah. And I always say the same thing. The consumer of these days in 2024, nowhere near the consumer in any time in the American history. Consumers right now are spending like lunatics. Partially, yeah, media is to blame, professionals, bulls, all this crazy optimism to blame, reckless spending habits to blame. But you guys, we go back to 1920s. Look at, there's no gap in CPI and Case-Shiller. There's no gap. You want to compare the 1940s too? I know Lynn Alden does all the time. There's no gap. The consumer was way different. The gap started in the 1970s. But look at the gap right now, you guys. If this isn't a bubble, what is it? If this isn't a bubble, what is it? This is Case-Shiller adjusted for inflation value of homes. And then CPI, the health of the consumer. Look at the freaking gap. We don't even know what to do here. This gap is, so again, educated home buying podcasts. Okay, maybe we could do one together. Maybe, it's the problem is I don't know what data they're using, but this is what we're talking about. Educate your home buyers. Educate your home buyers, Jeb. Educate your home buyers. Show them what you're looking at. Show them what you're looking at, please, because you're the Educated Home Buying Podcast, not the FUMO, right? Not the fear of missing out home buying. Are you? Here's another reason. Okay, I got 1, 2, 3. Boom, boom, boom. Okay, another reason. I'm going to go quick here. Dude, real median household income, this is adjusted for inflation, has been going down. All right, it's been going down. That's another point I have, and I tell Jeff this all the time. And it's like neither of us really know yet because the story's still being told. But I'm like, Jeff, dude, like, how can people continue to pay this? Like, house prices are going to go up. Like, how the hell can people pay that if they can't make more money? Adjusted for inflation, real median income. And this is a super lagging. I hate that. This is only to 2022. So I definitely hate that. But you guys, it's going down. It's been going down since 2020, since 2019. Look, this is right here. It's been going down. So you're asking consumers to pay something for something that they couldn't afford since 2019. So since 2019, we couldn't afford this, and it's just got worse, and then it's going to normalize. I don't know. You know, it's just, I don't know. I just don't think so, man. I just don't think so. Let's see. Let's go into the next thing, you guys. Right now. Oh my gosh, what's the next thing? Okay, it's gonna get nasty here now. I'm sorry that I'm lagging, you guys. I really am. I really am. I wanted to be careful how I'm saying this. Now let's play this next part of the video here. I think that this is really going to hit home the point I was trying to make. So let me just fast forward, like right here. Okay. All right. Take a look, guys. Take a listen to this. Let me know what you think about this next part.
Is a little bit absurd.
Josh, that's a perfect segue into, if you need a real estate agent or you want to work with Josh and our team on the mortgage side, do us a favor. There's a referral link actually in the description of this video where you can get connected with us. We can have a conversation about your situation and help guide you, based on what your goals are. And if you find any value in the content that we're doing here, do us a favor, hit the thumbs up and subscribe to the
bingo, bongo. So again, you guys, just so far, they're just normal realtors. There's normal realtors. I appreciate the loan officer, but you can't let things like this get you upset. Remember, they're just using data that they want. They're also in a tight. Maybe they're just looking at the California housing market, and they're designed to get you to call. So again, just keep your guard up. I mean, you've seen what we're talking about so far. I'm going to play another clip here about. Oh my God. Okay, let's play this next clip right here, and we'll keep it going.
Where that relates to home prices is if I'm a homeowner, Josh, and I'm in my neighborhood and there's a similar house down the street goes on the market for say $1 million. Well, I immediately think my house is now worth $1 million, right? Because
100%.
my house is nicer. That's what all sellers think. My house is in a better location. Those people did some crazy things to their house. I never did that. I'm better in all ways. So I'm never going to sell my house for any less than John sold his house for down the street. Therefore, mine's $1 million. Well, guess what happens as the market corrects? In some cases, more inventory comes to the market. Prices, in some cases, do come down on a nationwide basis. But
did y'all hear that? Did y'all hear what he just said? I mean, they're roasting me this whole time, talking about Crash Bros, and he just said prices will probably come down, inventory's going to come up. Did you hear him say that? Flip flop. What does crash mean, Jeb? What does crash mean? Flip flop. You guys see my point? And another thing, he's basically saying stupid sellers. That's what he's saying. He's saying stupid sellers, and he's not explaining, and this is what pisses me off. It really does. He's not explaining the education part. He's just slamming people. The education part, Jeb, what you should be talking about is subdivision freaking review, which I had to forfeit today to talk about you. Or my whole community right now would be learning about freaking subdivision analysis, which is the king. If we have access to the MLS as consumers, we don't have to trust clowns. We don't have to trust people with hidden agendas. We can do it ourselves as the public. Stupid sellers. You guys see what I'm saying here? Like, where's the education at here? Okay, where's the education? Let's go to this next part. Oh my God, Jeff, this is for you, Jeff. Okay. So listen to them try to explain the difference in nominal versus real. I'm going to tell you guys, okay, remember, then this is Jeff and I's biggest disagreement. Real is adjusted for inflation. Nominal is just the nominal amount. It's not adjusted for inflation. Okay, so let's listen to them explain this.
Looking at the home price, and we're going to go through here in the next step here why that's actually rational, why that's a logical way of looking at it for homeowners.
Well, actually, let's start with an example here. When we're talking about nominal home prices, we're talking about inflation. If you bought a $300,000 home in January of 2010,
wait,
inflation.
Hold on. Okay, hold on. Whoops. Sorry. Hold on a second. Just hold on 1 second, guys. Okay, let's hold on 1 second. Let's look at this comment. Let's look at the comment from Matt real quick, okay? One is selling videos on YouTube. Yeah, I get paid to do videos on YouTube. I try to do a real good job. I try to earn the money that I'm making on YouTube. I don't see anyone outworking me except a handful like me, Kevin. That guy is a maniac. Okay, one is selling homes. There isn't a lot of difference between these two. Okay, all right. So, do you guys see? Matt, you're listening to them too much, man. If you don't understand the difference of you watching a free video because it's free for you and you spending a $750,000 on a house that you're locked into to the next 30 years, purchasing at the worst time in history from every data set, you're delusional, brother. There's way bigger difference in what we're doing. If I'm out selling houses and I'm wrong, guess what? If I'm wrong, people are locked into their house, potential financial ruin and overwhelming anxiety if they're wrong. Okay. If I'm wrong, people should be in a better situation than they were before they started watching me. I'm not charging for my home buying course. My home buying course is free. I'm paying for my home buying course. So again, Matt, you know, if I'm wrong, people, if they are really listening, should be better off. And some people have already purchased a house. If they're wrong, people are screwed. The difference as well, Matt, is maybe I'll get for this video $60, $70. Okay, Matt? I'm going to get $60, $70. If I sold you a $750,000 house, I'm making $21,000. Does that make sense, Matt? Does that make sense to you? Do you understand the differences? Was that clear enough, guys? I don't know if it was clear enough, but dude, you got to stop listening to him. I mean, that's why I even, I get it. This is why I have to respond to these videos. Like, my God, like, how do you not know the differences? Is that Johnny? Johnny, you trolling me? That's Johnny's account. Johnny, you got me. Johnny trolled me. Well done, Johnny. Well done. That can't be a real comment, right? Let's keep going. Clowns.
Alone would take that home today at $427,000. So just inflation alone took that $300,000 home to $427,000. So $127,000 without buyer demand being crazy, without, competition in the market and everybody fighting and paying over a house, just that in and of itself. And so, the Fed has a dual mandate. One is max.
Okay. First of all, guys, and before I went on that rant, he basically said nominal is adjusted for inflation. All right, I'm not going to go back, but he basically said nominal is adjusted for inflation. So first of all, you know what? Screw that. I'm going to go back and I'm going to play it for you guys. Let me find it
here. Why that's actually rational, why that's a logical way of looking at it for homeowners.
Well, actually, let's start with an example here. When we're talking about nominal home prices, we're talking about inflation.
See? He said when we're talking about nominal home prices, we're talking about inflation. The dude can't even get the difference between real and nominal correctly, and you guys wanted me to respond to this. I'm taking away from my community by responding to this. I'm going to tell you, he doesn't know the difference between nominal and real. He said nominal inflation. It's real, brother. You're talking about real prices. Real is adjusted for inflation. Home buying podcast, right? Home buying education. You heard him say it. I'm sorry, guys. I really am. I'm really getting worked up here. I'm going to have to take a walk after this to get my blood pressure down. Next part right here.
2%. 2% is their target. Right now we're sitting in the high threes. And so, you've got, if we're able to maintain 2% for the better part of 10 years, we couldn't even get to 2%.
Okay. He said for the better part of 10 years, we couldn't get to 2%. You guys heard him. Okay. Right. He said for the better part of 2 years, he said for the better part of 10 years, we couldn't get to 2%. All right. Better part of 10 years. Right. So let me show you, where's my other screen here? Let me show you where we've been as far as inflation. Here it is. Everything's going to be linked here. So for the better part of 10 years, we haven't been at 2%. Right. But let's look before lockdowns. Do you guys see under 2% here? I mean, maybe these glasses aren't the right prescription. They're not even prescription glasses. Maybe these glasses are broken. Do you guys see 2% here? Does anyone see you guys see over 2%? Oh, wait, here's one here, 2.3. But it's still 2%, isn't it? You guys, we haven't been struggling with inflation for the past 10 years. It's only been since lockdown. We had 1.4 Jeb in 2020. We had 2.3 in 2019, 1.9 in 2018, 2017, 2.1, 2016, 2.1, 2015, 0.7, 2014, 0.8. This is a bunch of BS, man. This is a bunch of BS. This is so bullshit. Excuse my language. So let's keep going. All right, let's keep going. Let's see what else we got here. They made a comment criticizing me about my data. So I figured let's just go that same premise.
Is doing their mandate.
Absolutely. And if we look over the last 2 years, homes have dropped in value. When you say that, people go, you're crazy. I see the headlines all the time. Homes are up 5% year over year, 6% year over year. Over the last 2 years, on a nominal basis, homes have lost value because
You guys catch that, right? See how they're flip-flopping? He's like, the homes have already lost value. So it's okay to time to buy. He's talking about real now. He's talking about real prices. I'm going to spare us that real quick. But you guys see what I mean? So one hand, it's okay. Just buy a house. Price is probably not going to go down. But on the other hand, what if I told you prices are going to go down? You think I'm crazy? Well, they are going down adjusted for inflation. Do you see the flip-flopping? Do you see the flip-flopping here? Maybe you do, maybe you don't. Okay, let's look at this next part right here.
home buyer puts 3 to 5% down and they get a 2% return on that every year, they're getting a 40 to 50% gain on the money that they invested.
So he's saying, okay, he's talking about equity, and he's basically not doing the education part of their podcast. Remember, there's like an education part. He's basically talking about it would be pure profit, right? So like if your home goes up 500, it's pure profit. But again, and this is really surprising because he's a loan officer. I think they're forgetting to mention a little something called an amortization schedule. All right, it's not pure profit. It's not pure profit. You're paying overwhelming interest if you purchase a house right now. If you guys get a loan amount for $324,000 at today's interest rate of 7.5%, you pay back $491,000 in interest, which equals 150%. So how much profit are you making after you take out all of the interest you pay? And by the way, you guys, the first year, you only pay your mortgage down $3,000. Second year, you only pay down $3,200. Third year, $3,400. So it takes you 3 years to pay your mortgage down 10 grand. 3 years to pay your mortgage down 10 grand. Where's the education? Where's the education? Where's the education there? You guys see what I'm saying? I mean, am I wrong here? I haven't looked at the comments, I'm afraid. I'm afraid to look at the comments. All right, let's go into, let's go into this little piece real quick. And I'm trying to wrap this up, you guys. This is crazy. So again, just more like you're stupid if you're renting. You're stupid if you're renting. Let me see this next part right here.
For the majority of homeowners out there, buying a home now, fixing that cost earlier, the earlier you can fix that cost in your life, the better off you're going to be long-term. And at some point, you're going to own that house free and clear, assuming you continue to make the payments. And the renter who just rents forever, when they're 65, 70, whatever retirement age is, they're still, paying whatever the going rate is at that time.
Okay, so here's my issue with that statement, you guys. Why when these bulls talk, do they have to say when you rent forever? Why can't we rent? Seriously, think about this. And again, this goes to pushing the narrative to just buy right now, it's okay. No one's talking about renting forever. I'm not talking about renting forever. Why can't we rent for 2 years? Why can't we have a 2-3 year plan to rent, stay on the sideline if we chose to, increase our credit, learn how to rebudget to save money? Why can't we have 2 years? Why does it have to be either owning or you're a forever renter? The reason is, this is why. I'm going to tell you exactly why. The fear of missing out. That's why. So because of the fear of missing out, either you own a home or you're going to rent forever. Nonsense. I say what people should be doing right now is if you got a plan, you want to buy a house, you're priced out, whatever's going on with you, you come up with a plan to rent for 2 years. And the important thing you understand is it's how you rent that matters most. If you're renting and increasing your purchasing power and learning, it's a great thing. It's an absolute great thing. Okay. All right. Let's see here. Okay. Here we go. Here's about forced selling. Let's go into forced selling now. All right. So forced selling. Let's go into that.
Sales worse than a forced sale. I mean, if someone loses their job, if someone loses a spouse, half of the income goes away and they can't make the payment, there can and will be forced sales. We talk about all the time. Things happen that make people move, death, divorce,
Absolutely.
Job loss, all of that stuff. It just doesn't happen at scale, which is what is required to have a crash or a large scale correction.
Okay. So we've already seen correction without those things, okay, without like overwhelming forced selling. But I will say, you guys, I agree a lot about what they're saying right here. What he's saying about us basically needing more forced sales. I do want to, remind you guys that every single year there's forced sales. Every single year, divorce, all of that type of stuff, obviously. But I also want to point out, you guys, that just like last time during the GFC, that didn't happen until recession. And here's the issue again. Where's the education? Okay. Because if we look, and I'm going to show you guys the data. Okay. This is the 10 and the 2. This is the largest, one of the largest indicators of an incoming recession. I mean, we've been waiting for freaking ever. You know what I mean? It's like people don't even want to look at this because, like, damn, I've been looking at this for 2 years. I don't want to look at it anymore. I get it. But nevertheless, it's still there. It's not like it doesn't exist. It exists. So when you don't acknowledge, when you don't educate consumers about that really important chart you guys are seeing right there, it's foolish. You're doing the community a disservice. There is warning signs. There is warning signs, the 10 and the 2. You guys, we didn't have out of control, all these out of control things until we started the recession. And look at this, guys. You know what? I'm going to go to this in a second. Okay, I'm going to go to that in a second. Let's go back here. These guys is really setting me off. All right. It set me off because, again, man, they're making me work harder, you guys. They're making me work harder. They're making me, I'll work harder. It's fine. All right, here's the next
Four cycles of downturns over the last 40, 50 years. Every one of those, the primary characteristic of it is at least 20% of the available inventory in the multiple listing service is bank-owned properties. So you're going
You guys catch that? Interesting. So he's saying, and there is some validity here to what he's saying. I don't agree that the numbers are accurate. I know that sales transactions were high in certain metro areas, but I think that's a great point. He's basically saying in REO, it's like the bank takes over your house. Now, there wasn't a flood of REOs. I want to make that clear. Eventually, it slowly came out because of loan modifications and all these other crap that just kept postponing this. So I like that. I think that he did a good job right there. So I want to give him credit right there. But, and I hope that volume was okay. But I also want to show you guys this, that form that I just had up. That's basically an indicator, okay, of where we're at. Okay, so this is U.S. foreclosure trends. Okay, now I want you guys to pay attention to this first part here. This is Q1 of 2008 to Q3 of 2009. This is kind of like, the boiling point of the foreclosure filings. Remember, after it's filed, a bunch of other drama has to go down first. So it's not like you file a foreclosure, boom, the house is for sale. It's a very long and tedious process. And you can see that in this data. Look at. So the blue line is foreclosures in process. You guys, foreclosures in process got up to a little bit under 1.2 million. Okay, but the actual foreclosures completed, look at how low, all under 200,000, probably more like 100,000. So even though, we had hundreds of thousands of people filed foreclosure, things were so sticky. There was legislation, loan modifications, different states to different things. There was moratoriums back in the GFC. I showed you that. It kept it down. It kept the actual inventory down. But what this really did, remember, sentiment. This really affected sentiment, and sentiment is incredibly powerful, especially when we're talking about the housing market. Okay? All right, let me another thing here, you guys, shadow inventory. Oh my gosh. Now, again, this next comment you guys are about to hear, I think that this may be a result of his market. Because, this guy's saying there's no such thing as shadow inventory. So I think it's maybe his market, because like in my market, all I have to do is open the door and take 2 steps outside to see it. So if he's in Orange County, I get it, right? If you're in Orange County, I understand.
That's going to say, well, what about the shadow inventory? I'm going to tell you right now, there's no shadow inventory. So you can actually hold that comment to yourself for another time.
I won't even go there. But I think that he probably is talking about, in fairness to him, probably in his market in California, there's not. But take a listen to this, guys. This is
everything is based on supply and demand. But with that, Josh, let's talk about supply, because that's the key ingredient at the moment. Inventory nationwide at the moment sits around 526,000 single family homes at the time we're recording this. That's about 30% more than a year ago, which is, wow, that's a huge jump. We got a lot more homes on the market. But if we look back to 2019, a more normal market, we're well below those numbers. We were sitting somewhere around 1 million, just over 1 million at that time. Take us back to 2015, a more normal market. Those levels back then, 1,042,000 homes on the market.
Okay. So you guys caught, I hope, okay? I hope you guys caught that he said 560 homes right now listed. Now, he did say single family residence, Okay. So I want to give him the benefit of the doubt and say maybe he's just talking about single family residents. But I'm going to tell you right now, we have way more than 500,000 active units. This is the most recent Fred economic data, active housing units. And this is only active. This is not counting pending. And we have 694,000. Now, about a year ago, we had in the 500s. So I don't know, Jeb, are you using 2023 data? Oh, that's right. We can't check because you don't show us and you don't use the link. But it kind of seems like he's using 2023 data because that's exactly how much houses we had back in April of 2023. And before the pandemic, you guys, we had 1 million. So is he talking about 2023? But again, I'm going to benefit of the doubt here. Okay, benefit of the doubt here. Maybe he's just talking about SFRs. Maybe. Okay, but when I go to housing inventory here as well, and we look at active and pending, we have 1.1 million. So again, it's just like, man, what are you talking about? Like, what do you mean we have 500,000? What do you mean? So, again, maybe he's just talking about Orange County. Okay. Oh, by the way, here's another set of data that says 840,000 active listings. So maybe he's talking about SFR. So I went to this right here. This is Orange County. And I wanted to see, okay, how many, maybe he's saying that because in his market, there's only single family residences. So when I go here, I check single family residences. It shows in his market, there's 1,000 single family residences. But when I go to townhouses, we have 126. And when I go to condos, there's 558 condos sold in his market in Orange County. The total percentage of townhouses and condos accounts for 38% of his market. And he wants to leave that data out. Why? Jeb, I would like to ask you, sir, maybe it is SFR you're talking about. Why are you leaving out townhouses and condos when your own housing market, 38% of that consists of those types of properties? Are you just using the data you want to get people to feel comfortable purchasing a home? Because it's not like a stock market, right? We can buy real estate emotionally and we're fine, right? Because it's a necessity. You don't want to talk about payment. You don't want to talk about unaffordability. You don't want to talk about what a recession can look like. And you went through it, buddy. He went through it and he doesn't talk about it. Pretty crazy, pretty crazy. All right, let's see here. What else do we want to do? Okay, let's listen to this last bit, you guys. And then I'm going to get you guys out of here. So this is this last bit right here. This is an interesting one. All right, we'll go back into this right here. I hope you guys appreciate this. I mean, I wish we could do subdivision analysis.
The numbers. I've run the numbers on how undersupplied the U.S. housing market is. The most conservative says we're 1 million units short. The most aggressive says we're 4.4 million units short. So
it's probably somewhere in the middle.
4 million units.
Probably somewhere in the middle, somewhere between 2 and 3 million units short. We are decreasing building. We've pushed a lot of the smaller local builders out with inflation, with high interest rate, hard to get financing. And now all we have is the big national builders, which we've talked about ad nauseum here on the show. That what do they want to build? They want to build nice, big, fancy, profitable homes, not nice entry level homes.
That is 100% wrong. That's so wrong. I don't even know how you get that wrong. Because a lot of the narrative that the bulls is like, oh, the price going down to shrinkflation. And we have data showing that the houses are slowly getting smaller. So what he's saying is absolutely horse manure again. Now, I also want to show you guys, where's my inventory? Actually, here's my inventory. We don't need 1 million to 4 million units. I'm going to show you guys this right now. We only need, in my opinion, about 200,000 units more sustained. So we needed sustained because, again, going in, and we were already on a decline in 2019. Going into lockdowns, we only had 1 million to about 1.2 million in 2019. So again, right now we have 694. But remember, you guys, in 2019, consumers were in a better situation. In 2019, we didn't have these types of problems. In 2019, interest rates were 3.5, 4%. Wage growth was fine. The debt to income ratio was good. We don't have the same situation as 2019. And therefore, what I'm saying is we don't need the same amount of inventory. We have a different type of demand. We have a different demand than 2019. We only need, in my opinion, about 200,000 active units sustained. I believe prices are going to go down if that happens. But again, in conclusion, you guys, I get it. Those people, those educated home buying people are from a market that's super tight. But, again, my conclusion is on the video, and I'm going to say a lot of it is assumption. So I am making an assumption based on what little that I know. I'm not regularly watching these people. I got the email. I watched. I saw the comments. I'm like, fine, I'll listen to it. But to me, you guys, this to me, it just seems like they're saying education home buying podcast again to get you to feel safe, to get you to put your guard down, and to get you to feel comfortable submitting a lead into their system. And that's what I believe we're seeing right there. And another thing, you guys, I hate the fact that they're acting like it's still 2021. These guys are still acting like it's 2020, 2021, and that there's like almost no risk in buying right now. So I absolutely hate that. But overall, you want to know what I really think it is? Let me show you guys. This is what I really think it is, guys. Okay? This is what it really is. All that's happening here is they're regurgitating information from Lance Lambert. That's all that's happening here. So Lance Lambert came on, gave them all this new information about real and nominal, and oh my God, they empowered them because Lance has a new data provider company and he wants to push it. So they're regurgitating what Lance Lambert is saying. He's going around to YouTubers that are bullish in the housing market and going on all their channels so he can sell a subscription. That's my assumption. Don't hold me to that, Lance. I'm assuming I know nothing about you, except that they're regurgitating what you're saying, but they're doing a horrible job. They don't even know the difference in nominal and real. It's Lance. They're regurgitating Lance. They are, in my opinion. Okay. Again, they're saying emotion's okay. Zero risk. There's going to be massive growth. I hate those things. And I hope I didn't kick them up, beat them up too much, you guys. Let me just move on now to super chats. I'm going to, finish it right there. You're feel free to believe what you want to believe, but that's just my impression. Let me go to the super chats real quick, guys. I got a ton. I really appreciate you guys. I got one from a realtor named House. Adam, love you all. We love you too, man. Thank you for being a realtor that we can communicate with and talk about difficult things. Thank you for being a realtor that doesn't get so emotionally upset that you just attack people. Thank you for trying, brother. And that I'm going to tell you, that's all you need to do. Okay. Well, a couple things. You need to be honest and forthcoming. Okay. You're honest, you're forthcoming. You're going to be better than almost any realtor you ever meet. Forthcoming. Thank you for the super chat, brother. There's my buddy Todd right there. Todd, love you, man. Keep on keeping on. You guys watch Todd, man. I miss you, Todd. We got to do some stuff together. I'll say, man, Todd's one of a kind. He's an absolute lion. This is a good man. He loves his family. He loves his children, and he really loves his community. He does. He loves them. Now, he beats me up sometimes, and I had the bruises to prove that, but that guy's a great guy. That guy's just such a great guy. WTH, restore the pick exposing YouTube realtors with X marks. Maybe. That's interesting. Thank you for that. Okay, I got another one right here. Great video. Keep dunking these fear of missing out cheerleaders. You guys, and I mean, thank you, Nikki, so much for your support. Again, I'm just going to go back to, I don't want to do that, man. I feel like for me, it's a little bit of a waste of time. It's a waste of energy. They're going to keep saying, we can't change people like that. That's what I'm saying. Like, if we could have a conversation and maybe work things out and talk and share opinions and sharpen each other, it'd be different. But I don't believe that's who they are. I believe who they are lead generators. That's it. And so I don't know what you guys think, but anyways, guys, I am going to get out of here. Don't forget to go to the Discord. I hope you guys like it. I won't really have it chaptered. I will be back on Tuesday. And I want to warn you again about one thing. Okay. This has been happening. I've been getting phone calls like this. My own client went through this. If you're going to purchase a new home, listen to me. You don't want to find this out the hard way. A whole bunch of people are finding this out the hard way. You have to listen to me. If you're going to buy, or anyone this is how bad this is. Anyone is buying a new house, people are getting destroyed right now by surprise tax bills, not like the normal ones that they just go up. I'm talking what happens is the loan officers and title companies are using the property taxes based on dirt value and not the dwelling. And so what happens is the first year of home ownership, these people get a $10,000 bill and their mortgage payment goes up $1,000. All because the loan officer and title company did not set up the proper escrow account in the beginning. So if you are buying new, make sure the right property taxes are being calculated, because they never are. Except when I was a loan officer. Apparently, I'm the only loan officer that knows how to do that. But anyways, guys, I'm going to get out of here. I love you. Join the Discord. Everyone's in Discord. I love you guys. I really hope you have a great day. I'm sorry for getting spicy. You know that I really want to lean towards love. But I don't know. I guess I just had to do that. Appreciate you guys. If you guys are out there investing in real estate, you guys already know I think you should slow your roll. But I do wish you luck, and I hope you win.